Hello everyone, my name is Kokilan Maheswaran. I'm a real estate agent focusing in the GTA. I'm with Remax Metropolis, and today I'm with my mortgage partner Varshan from the Banyan Mortgage Group. And what we're going to do today is dig into what's happening on the ground level in terms of real estate and also what's happening on the mortgage side.
Yeah, no, I'm excited to, share what we're seeing on the mortgage side and excited to hear what you have to share. I think there's going to be a lot of insights that we're going to be sharing, a lot of things that are happening on the ground that, most people will not know about. So there's going to be a lot of actionable items here that people can take away, and hopefully, learn a thing or two that will help them in their home buying journey as well. So excited to get this conversation started.
I'm excited as well, so let's get to it.
Yeah. But yeah, the market, I think right now we're seeing, 2024 is a very interesting year. I think I'm surprised to see, but there's a lot of activity on the buyer side, especially on the first time home buyer side. I think a lot of folks are starting to get back into the market. They're seeing these opportunities that, may have passed by in 2023. Of course, rates lowering, which are the fixed rates, have also helped. People are able to buy within their budget now. So I think that's sparked a lot of demand. And I think a lot of people are seeing the benefit of, getting in early while rates are, still high and prices are low, and then looking at the options of refinancing. And I think the Bank of Canada, saying that they are close to or have paused rates for, now 7 months now. I think that's put a lot of confidence in the market for folks to, have the confidence that rates are going to drop later this year, right? And ongoing for the next 2 years. So that's what we're seeing on the buying side of things. Mortgage market wise, we're seeing the fixed rates lower each month. And I think right now we're roughly about the high 4s, low 5% for like a short-term fixed rate. And we do expect that to go down even further over the course of the year. And then variable rate, we're most likely going to see that come down 1% over the next year, and then another 1% over 2 years. So a total 2% drop over the next 2 years. Of course, this is a forecast. It's not guaranteed, but this is what the top economists are saying currently. So I think that will spark a lot of demand in the next 2 years for sure.
Now, you mentioned that fixed rates have gone down since last year. One thing I've noticed also is the discounts for variables. I'm starting to see the prime -1 again, which I didn't see last year. Can you tell us a little bit about that?
Yeah, I think because a lot of folks are going towards the fixed rate option, I think the bank wants to, make that variable rate option a bit more enticing, right? And because of that, I think, and in addition to people seeing that the rates are coming down or forecasted to come down in the next few years, I think it's making variable a more attractive product. If you were to ask me if I was taking a mortgage on today, I would personally take variable.
Interesting.
But not everyone has that risk appetite. And having that deep understanding in the mortgage industry allows me to take that risk. But it's not advisable for everyone, for sure.
Fair enough. So in terms of the real estate side, again, 2024 has already started off being interesting. And for last month of February, I think we had about 5,600 transactions, so almost 6,000 transactions. Wow. So 12,000 ends where there's a buyer and seller. And the prices went up by about 90 grand in just that 1 month. So it's going to be interesting to see if that continues for, March, April, the summer market, spring market and stuff like that, and how that changes if rates do change. But for sure, the activity is definitely back. Like putting the prices aside, the fact that we have this many transactions, you see open houses ticking up in activity again. You're seeing multiple offers here and there. Again, all that adding to this year, we didn't really see that last year. So it's definitely going to be an interesting one.
Yeah, no, that's just to kind of piggyback off what you said, like bidding wars wasn't even a thing in 2023 really, right? But starting 2024, we're seeing like even the news is picking up on this stuff, right? I'm sure you saw that one house in Mississauga that had,
that went viral.
Like I think 80 offers or whatnot, right? But I think that's just the norm, right? And I think one thing to really point out in this market, and you probably see this more than me, is when there's even just one more person bidding against you, the prices are going to go up.
Like the dynamic changes, right? Again, like when you're with the client, it's like their perspective and they get more emotionally involved when there's more offers. So that's why when, there's properties sitting on the market for quite some time or there's room for negotiation, if you don't want to be part of bidding wars, that's your opportunity
Exactly.
to negotiate the price, conditions, and all these other terms. Whereas in other cases you won't have that. And I think mainly right now it is for freeholds. I think for condos you're not really seeing the multiple offers just yet.
Yeah. No, I think that's valuable advice for sure. Because a lot of folks, first time buyers, I'm sure you're seeing, and like when we pre-approve clients, the qualifications are within like that condo or condo townhouse price range, right? So I think that's important for people to know because they still have that negotiation power when they're going into those scenarios, right? Versus if you're going right into detached, you're gonna expect to bid against someone in most cases, right? So that's good. So I do want to ask, like, what kind of trends and behaviors are you seeing from your clients in the past like 3 months?
So that's an interesting one. So I was speaking to one client who lives in Pickering as well. So he has a renewal coming up next year. His monthly payments are $2,500, and he voluntarily doubled his payment to $5,000 to pay down the principal and to have like a lower payment once renewal comes up, which I thought was interesting because obviously you need to be able to have the capacity to do that. But the fact that someone is taking charge instead of waiting, I thought was pretty interesting. And there might be people, who are putting money aside in preparation for these things as well, right? And also in a high interest rate environment, people who have multiple properties, I've helped with, some people have sold their investment properties because they want to hold on to the primary residence. That even though this one client was still cash flowing at about $1,000 a month with a high mortgage and a high interest rate, he thought it was beneficial just to offload that property, take that cash and just hold it aside as a rainy fund or to put towards the mortgage. In other cases, people are starting to do their basement and rent it out to get $1,500 to $2,000, which helps alleviate some pressure on the mortgage end. Or they're looking at side hustles or like a part-time job to help supplement the money that's coming in for these harder times. What are you saying?
Yeah, very similar to what you said. We are seeing a lot of people tackle these like rates up front, right, rather than waiting till renewal. So they're doing those lump sums, like you mentioned, to bring that into a balance, right? But I think a lot of people are also, calculating what their mortgage payment will be. So I'm getting a lot of inquiries for people who are renewing in the next year, asking, hey, what will my mortgage payment look like a year from now, right? If I were to renew at today's rates. And when we look at the calculations, most people are actually okay with the rise in prices because So even if the rates are, let's say, right now they're at 2.5 and they're renewing at 5%, which is double, right? Doesn't mean your payment is going to be doubled, right? And I think that's a lot of misconception that people, automatically think about. And over that course of 5 years, their salaries have increased quite substantially, right? They may have another partner in their family that could contribute to the income, right? So there's a lot of changes that happen in 5 years, especially when you're buying young, right? That could really kind of help you with the rise in the cost of living, right? But in scenarios where people are really struggling with that renewal payment or are very worried about it, they do have the option to increase the amortization back to 30 years if they need to, and that in most cases will help decrease the payment by 10 to 20% depending on what their current amortization is. I've also had people who have renovated and completed their basement apartment, rented it out, house hacked. I even had one client that lived in the basement, rented the top out.
I have
right?
one like that too.
Yeah. So like at the end of the day, it's a lifestyle decision, and if it's temporary, most people are okay with it. Especially if you're single or it's just the two of you. But yeah, like I think people are being a bit more creative, right, to figure out how to kind of tackle this ahead, right? Because it's not just mortgage rates, right, and housing. There's gas. There's a lot of food costs. Like there's a lot of other costs that have gone up too. So that's why a lot of people really have to like budget nowadays more than in the past.
For sure. So with inflation and higher rates, people's concern right now is number one, how are they going to survive if properties are going to come for sale, and what's going to happen when rates go up, right? But one topic people aren't talking about is how is people's behaviors and perspectives going to change if rates go back to 4% or 3%. How do you see that playing out?
That's a great question, man. I think it kind of takes me back to like when our parents were going through the 90s and early 2000s where interest rates were like in the double digits, right? And because it was in the double digits, they kind of put that fear into the next generation not to buy real estate because number one, real estate did not increase at all for, I think it was like 10 years, right? It stayed flat for 10 years. So it didn't really make sense to buy real estate as an investment, right? But then everyone who missed out on that, the next 20 years was, up. I don't know how much, but at least 10 times, I would say, right? Which is pretty crazy. But I think going forward now, I think people will really think twice before they make an investment decision when it comes to real estate, right? Really plan out, okay, not just like the next 5 years, what is the next 20 years going to look like? I think also a lot more people will take the fixed rate more than the variable rate. True. Because I think a lot of people who did take the fixed variable rate were hurt, right, by the increases. So I think that will definitely change behaviors going forward. And I think also a lot of folks will definitely put more emphasis on paying down their mortgage going forward as well, right? And I think that's always very important. That's like when we get our clients' mortgages, number one, our mission after that is let's pay it down as fast as possible, right? Because we want to take that money back out from the bank. And there's a lot of strategies you can do for that. But those are the main behaviors that I think will kind of be influenced over the next few years due to inflation.
Yeah, I agree with you. I think years before, one of the strategies people liked is still having a mortgage and leveraging. And I think people are going to be a little bit more risk adverse where they'll double think before making the next investment, or they just simply want to pay the mortgage down in half the time and just be mortgage free. Yeah. And I think people are going to be more than okay with that compared to before.
Absolutely.
So for the past, say, year or so, one of the headlines you always see is this big renewal shock that's going to come in 2024, 2025, 2026, because, so many people took mortgages that say 2%, rates are now at 5 to 6%, and, that's going to cause so much chaos. But there's so much things behind that because a lot of people have felt the pinch or they have renewed or they have sold, which they don't talk about that in their numbers, right? Yeah. So can you tell us a little bit more about that?
Yeah, no, that's a great question. And just like you mentioned, everyone's situation is unique, right? There's a reason why mortgage defaults are like still historically low. And the main reason is that, like I mentioned, over 5 years, a lot can happen, right? In terms of income and whatnot, right? In most cases, we've seen over 5 years, your income can substantially increase, right? Whether if it's one person's or two people's that are on the mortgage, it could definitely help offset the increase in the cost. And although, we're going from 2 to 5, let's say, right? And it's more than double, your payment is not doubling, right? And there are options such as doing 30-year amortization to reduce your monthly payment, right? But in most cases, we're finding, at least with this year with renewals, people are okay with the increases. They're leaving the amortization as is because they want to pay down the mortgage, right? And the renewal shock isn't as bad as, the headlines are putting out there. I think another thing also is a lot of folks are, using basement rental apartments to offset it, or other side hustles they may have to kind of offset the expenses, because I think almost everyone I know has some sort of side hustle, right? So definitely there's additional income outside of the traditional income that's helping them pay that additional cost. But also I think, number one, just if I can give a tip for anyone, is when you're up for renewal, at least 6 months earlier, start shopping around. Don't just, accept the offer with your bank or go to the bank and just negotiate with them. Look at what other banks are offering. Speak to a mortgage broker. Kind of see what the market is saying the rates are currently, or the lowest rates, and then just take it from there, right? I think that will save you just alone $10,000 at least over the term. So I think that's very important for everyone to do as well.
Right, and again, it's not always just about the rate. Sometimes it comes down to what the monthly payment is, right? And I think a lot of people really still don't understand with playing around with the amortization, right? Like, for example, if I bought a house in 2015, I probably have 15 years or so left if I took a 25-year am. If the payments are my main concern, I can stretch it to 20, 25, 30 years, right? If not, you can just let it be. And shopping around for rates, even if you save 1%, still adds up.
Yeah, right? It's huge. And also, like, your qualification will change too, right? Because 100%. If your income has gone up, and also maybe when you bought it was a little bit easier to qualify, right? Because the rules have changed over the last 5 years. So even if you are, having to stay with their current lender. There are strategies if you talk to a mortgage broker where you could still get a lower rate with the current lender. Might not be the lowest in the market, but it would be somewhere within that range, right?
And I think also back to the whole mortgage shock situation, in terms of qualification, people are already qualified for 2% higher in the event that something like this would have happened, right? So I feel like there is a little bit of buffer that was there.
100%.
And obviously when you pass that 2%, because rates went up by more than 2%, that's when some people will get in trouble. And I think for the most part, people who have mortgages over 800,000, they'll feel the pinch because payment goes up by 2,500 or so. Right?
Exactly.
Again, case by case.
No, for sure. And just one more point is also like when it comes to renewal, it's also important to select what type of term, what type of mortgage you want, right? Do you want a variable rate because of what's being forecasted for the next year, 2 years, or do you want a fixed rate so you can really budget exactly how much you're going to be paying, right? So all of that is very important to discuss during your renewal time. Yeah.
I mean, for years I was always a fan of variables, even if
Likewise.
my payments always increased. It's not one where the payment stayed, but after the brutal past year or two, I'm thinking. I might have to go back to fixed.
For sure.
When things are.
It definitely makes you rethink it, right? And I think. A lot of people are going to do that, right? Yeah. And I think you'll see an opportunity where then you'll start to see the variable come down quite significantly and the fix will be higher. So it'll kind of like change your perspective in that sense, right?
Yeah.
Where
I think that's how things used to be.
That's what it is. Yeah, it typically is. Yeah. Fixed rates are usually higher than the variables historically, but there are certain times like the last 2 years where the variable is intended to be higher. And that's all, to bring the inflation down, right? So they can level the economy.
Yeah. Got it. Okay, so in terms of financing, obviously when we're on the road, we see the big 5-6 banks. But also one of the benefits of working with a mortgage broker is you have access to other lenders whose primary focus is mortgage lending and they don't have branches and stuff like that. So I guess there's B lenders, C lenders, so on and so forth. Tell us about B lenders.
Yeah, so B lenders are kind of like that bad word when it comes to, when it
that's
comes
what the B stands for.
Yeah, exactly, right. So that's kind of the misconception in the general public, but in reality, they're there to help people, right? And how they help people is a few ways. Number one is people who have credit issues, right? Recent bankruptcy, things of that sort, or, just have a low credit score that the bank is not willing to lend on. They come in and help you achieve home ownership. At the end of the day, they're trying to help people get into homes, right? But where they particularly are, advantages is for self-employed individuals. So they have unique programs, what we call stated income programs. And what that is so typically the bank will look at your reported income, which is your tax return. And as self-employed individuals, as both of us are, you're trying to report as little as income as possible, right? Because you want to save that taxes that you owe to the government, right? And you have the power to do that as a self-employed individual. So when you go into the bank and you're showing your, let's say, $20,000 income, right? You're not going to qualify for much, right? But in reality, your business is earning, let's say, 100,000, right? With the B lender, they're going to look at the 100,000 less whatever expenses you have to run the business. It's only not your household expense, just the business expense. And let's say that comes to like 70,000. They're going to use the 70,000 to qualify you.
Right.
So they're using a much higher income to qualify you versus the bank. So that's the number one advantage with B lender for self-employed. The other advantage is because they're using that income and not your tax reported income, you actually can save a ton of money on the tax side, right? So for example, if you are needing $50,000 more to qualify for a loan, right? That's going to cost you about $20,000 in taxes. So you're going from 100 to 150,000, right? So that's going to cost you $20,000 in taxes. The bank needs 2 years worth of that. So that's costing you $40,000 to get into this house with the bank, right? With the B lender, all it's going to cost you is a 1% lender fee. Let's say $700,000 home or $700,000 mortgage. That's going to be $7,000. Plus the interest rate is pretty similar to a bank, right? In a 1 and 2 year rate. So the interest cost for the 2 years is about, I would say, like 8,000 to 9,000, right? So on a $700K mortgage. So roughly you're paying only 14 to 15K more versus paying $40K to go with the bank, right? So that's where you're really saving money, and a lot of people don't realize that when they're self-employed. Salaried individuals, typically they go with the B lender if like they have the credit issues or they want to stretch their budget a little bit more than the banks can offer. But they're really like what the name sounds like. They're like an option B, right? If obviously we want the bank as our number one option because they offer the best rates, right? And various other products. But not everyone can qualify into them, right? And they still want to be a homeowner, right? So that's where the B lender really shines and comes into effect. And one thing I also wanted to kind of know, because I've seen some of my clients take advantage of this, is even if, let's say today, someone can only qualify for $500,000 with the bank, right? A B lender may qualify them for $650,000. And we both know $500,000 is only getting you so much. $650,000, yes, it's still not much more in this market, but it will get you a lot more than what $500,000 could get you. So I have clients who are actually going with the B lender, taking the $650,000, right? They're paying the 1% fee, but they're taking that 1% fee because they know that $6,500, let's say, is the fee that they're paying, is going to be much less than what they're going to gain in the appreciation over the next 2 years. And over the next 2 years, they'll work on a strategy to convert that to the bank. We always have an exit strategy when people are going to B lender to go back to the bank. Like, it's always important to kind of have some sort of exit strategy. If it makes sense for you to stay with the B lender until the end of your amortization, that's all good too, right? And we do have a lot of self-employed individuals who plan on doing that. So yeah, overall, B lenders, I think they can be used as a tool, right? More than, kind of like avoid them at all costs, right? So that's kind of the myth I want to like demystify there. Yeah.
Right, and I think one of the main things is the rates are usually not that much of a difference, right? Like, you want to belong. I think there might be some pride in belonging to one of the big six banks, but if the rates are very similar and you're able to buy a house today rather than waiting a year or so, there's a one-time fee, right? You're at least able to get into the market. You have it. Everything else is the same, right? The mortgage company funds the amount, and you're paying it every single month, right?
Yeah.
Now, in terms of amortizations, do they go beyond 30 years? Say if someone wanted that.
So last year we actually had a few of them that were offering 40-year amortization, which is great. That's no longer available, unfortunately. Right now we have one or two that are offering up to 35. But not more than that. And I also want to know, because I think it's very important to know, is for B lenders, there is a higher down payment requirement. You do need to put 20% down. So if you're looking to buy with less than 20% down, you won't be able to use the B lenders options. But there are other down payment assistance programs that can help with that, and we can talk about that later.
Okay, so that leads me into the next question. So obviously when some people, when they're beginning to get their house hunt started and they reach out to a realtor, we say, sit down with a mortgage professional and look at your options. Again, some people love belonging to the bank, especially the bank that they bank at, which really makes no difference. I have firsthand experience. What's the difference between them going into a bank and going into a broker? Could you touch a little bit on that?
Yeah, that's a great question. So, I mean, there's a lot of differences, if I'm being honest. But I think the main thing is, I think a lot of people don't understand that brokers actually work with banks as well.
Right.
So most of our mortgages, I would say over like 70% of the mortgages that we do are with banks, like major banks. So all the banks that people bank with, right? So I think that's where people first get misconception, thinking that, we only work with a broker because we need help with credit, or, our mortgage needs to go with like a B lender and things of that sort. But in reality, we work with banks. So we love the banks, right? But I think the biggest misconception is, on the bank side, they're only selling their products, right? So they're more of a salesperson for their own products, right? So that person who's getting your mortgage is only there to sell you what, let's say, for example, TD. They're only there to sell you TD's product. They're not going to advise you and tell you, hey, listen, the blue bank over there might be a better option for you because of, they allow bigger prepayment privileges, or they allow you to, get a readvanceable loan, or whatever it may be, right? So there are a lot of different features that each bank has different features and different programs that, one bank may not have, right? And for you to really have a whole picture of that, a broker can advise you of that. And we're licensed professionals, so we can actually provide advice. Where in the bank, they cannot provide advice. They're not allowed to provide advice, right? Because they're only offering one product, right? So I think that's the biggest difference between the two. And then the other one is, because we have alternative options as well, right? We're kind of like a one-stop shop, right? So when you come to us, we kind of assess your situation. If the bank is the best option for you, we're going to get it done with the bank. And in most cases, we're actually getting better rates than the bank. We've picked up the ball where, people have gone to the bank, bank's not responsive. They reach out to us. We get it done with the same bank at a lower rate than what they were promised, right? So I think a lot of people don't know about that without, either through word of mouth or going through the experience themselves. So I think those are the biggest advantage. And I think it's also the future advice that they get as well, right? So we always make sure that, after the mortgage close, we're also providing ongoing advice to help clients, either buy more real estate, if that's their goal, or how can they upgrade to a bigger home, right? So everyone has different goals, and we're there to kind of put a game plan together to get them to those goals as quick as possible. Whereas the bank, they're just here to kind of, get things done as you want, right? But they can't really advise you on whether you have the best mortgage or not, right?
Yeah, which is pretty crazy to think that you're making your biggest investment and you're not looking at all your options, which doesn't make sense. And I can tell you a success story firsthand, and coincidentally, you were the broker on the other side. So I had a client who went into 1A lender. They got approved for, say, 1.1. And the type of house that they wanted, it was in a hot market where, it was going for 1.2, 1.3, 1.4. And then I connected you to them, and they wanted to explore, looking into that B lender. They're okay paying that 1% fee as long as they get into the house that they really want. So they got approved for 1.4 with the B lender. And then eventually we did find something for 1.3, and you still got that approved with another A lender. No B lender fee, still with A lender bank, and still with a great rate, right? Whereas if they didn't, they probably would have gave up on their search, because in their head, they're thinking, I can only get approved for 1.1, regardless of where I go.
Yeah.
Right? So I thought that was pretty cool.
Yeah, no, I appreciate it, man. And I think that's the main thing, right? Like, just because you got to know from one bank doesn't mean the other bank across the street can approve you for more, right? And we see that a lot, especially there's certain banks that are more favorable for investors. There's some banks that are more favorable for, first-time home buyers, things of that sort, right? So I think it's just, that's why that advice piece is huge, because you get a full perspective of, the entire lending landscape, right? Rather than just working with one bank.
Got it. Continuing with, options people have with the broker, type of mortgages, creative ways to get into the market, down payment wise, right? So say, for example, I want to buy a house. I have 50 grand. The house that I want is $1 million. I need another 150. I could go the insured route if I qualify. What are some other options that could be available through, say, a broker like you?
Yeah, so great question. Again, like if you want to go through the insured path, purchase has to be under $1 million, right? And there's a lot of people out there that want to buy a house that they can qualify for over $1 million, but they just don't have the 20% down payment, right? So that's where we have certain programs, like down payment assistance programs, that allow. Like, they're not our number one option. Our number one option is always, if they can get gifted funds, if they can, get equity out of like one of their parents' property or whatnot, like as an earlier inheritance, things of that sort, right? So we always look at other options before we go to this option, but it's a great option. So essentially, we have a lender who will lend you the down payment, right? And the best part is there's no interest cost, nothing, right? Your minimum requirement is super 5%, and they'll pay up to the remaining 15%, but it is an equity loan. So what that means is whatever the property appreciates by whatever percent they put in, they will need that back plus their principal.
Right.
So for example, let's say you put 10% of your own money on $1 million, 100K, and they lent you the 100K. So for the remainder of the term, they're not on title, right? There is an agreement between the two of you guys that you will pay the money back plus the equity. So let's say the property appreciated by 10%. You actually have to give 5% of that appreciation to the lender with the additional 100K that they gave you.
Okay.
So that's how it works. So you're pretty much going into a co-ownership type of situation, but you're the one who's occupying the property, right? So it's a great strategy for those who are looking to get into the market, right? And not having to wait until they save 100,000, because saving 100,000 is not easy, right? So saving that, and then at that point you might be priced out, right? Whereas what you can do is you can use a co-ownership program, get that equity loan, and then refinance it, pay that company back, and now you're free and clear of the property in terms of the
So
loan.
when you refinance, do they look at, say,
Whatever
what
the
the
value is.
appraisal
Yeah.
comes in at?
Exactly.
And then they'll take their equity share
Yes,
based on
exactly. The main thing is they need to get paid full in their principal,
Right.
plus whatever the equity
Equity
on
is.
that appreciation is, right? It typically, even though 5% is the minimum, it typically works best if you put 10% so you can repay it faster.
Right.
Otherwise, you probably have to have that loan in for longer. And as we know, the longer you have it, the more the appreciation is going to be, right?
So if it appreciates by 100K, do they get a portion of what they put? Like say if
Exactly.
it's 50-50, they'll get 50,000
Yes.
on the refinance or sale.
Yeah.
Okay.
Yeah.
And is there any upfront cost for that? And I think in terms of you getting the main mortgage, it would have to be through a certain type of
Yes.
lender, right?
So it would be with the two B lenders,
Okay.
right? So there will be a 1% lender fee that they will charge.
Okay.
And again, the rates will be slightly higher than a bank, right? But again, these are temporary solutions with where we're looking to kind of get out of it in the next 2 years, right? So the ones that we have done in the recent past, typically the exit strategies have been, they'll also save money to pay them back, plus bank on the appreciation.
Right.
So while they're in the property, they may, like for example, let's say they buy a bungalow that has two, like a duplex, they may take some of the money they're getting from the rent and use that towards a fund to paying them back, right? So the main thing is you have to pay them back. So they'll use some of their savings plus the appreciation to pay them back,
Right.
because part of the appreciation they keep too, right? So
And if it does appreciate the way things have before, then you just roll it into one. And,
Exactly.
You have 20-30% built in, you have one mortgage, and you start fresh from
There
there,
you go,
right?
yeah.
Rather than saving up 20-30%.
yeah,
Right.
exactly. All right, so I'm sure you've heard of the news in the U.S. where that large lawsuit occurred, changes the ways how fees are being charged or potentially charged. I know it's not official yet, but I think that's brings us back to the real estate community here, and I want to ask you, like, can you kind of give someone who's like kind of getting into the market what the commission structure looks like, both on the buying and selling side, and what the benefits are on both sides, right, of a full service agent? Because there's a lot of people that are looking at different options. People advertise differently, but I think from what I see, or my mantra is like, what you pay is what you get. But maybe you can expand on that a little bit more.
No, for sure. So in terms of being full service and full time, that's a value proposition I always push. So when I'm in interviews, people ask me if I'm full time. I say if I wasn't full time, then I'll be doing you a disservice, right? You wouldn't go to a part-time surgeon for a heart surgery. I know some part-time agents are very good. They probably do more business than me, and by all means, no harm to that. But if you're not on the ground every single day and every single minute, that, like, everything that goes through my eye and ears, I take that as experience and education, right? So, there's a lot of trainings, seminars, reading articles, touching base with professionals, not only in the real estate community, but, contractors or mortgage agents, appraisers, or lawyers. Those are all things that I can't really quantify or put an amount to, but all that experience feeds into how I take care of each client, right? And the transaction just doesn't end there. Like, I still talk to clients who have bought, 3-4 years ago, still giving them, real estate advice or mortgage advice, because I do have some of that when I worked in the bank. So I think being full service is very important. In terms of commission, obviously I don't work in the US, so I don't know too much about it, but I think it was pretty much a normal thing for them to, when you list a house, it's a 6% fee.
Okay.
And the listing agent will take half, and 3% goes as a cooperating fee to whoever the buyer agent is, right? And I think a lot of people are a little bit misunderstood by that and thinking that is a good thing, but I think the person who gets hurt the most is a buyer, if that were to happen here, right? So pretty much even in Canada, I think we have it a little bit more different because the commission is always negotiable, right? So for the buying side is negotiable, for the listing side is negotiable. Now, obviously, most of the times we would see a 2.5% fee that goes to the buyer agent, but again, that is negotiable, right? So in some listing presentations, sellers have asked, could I offer 1%? I'm like, by all means you can, but you got to also understand that on the buying side, if the buyer and the buyer agent have a buyer representation agreement in place for 2.5%, that difference, the brokerage can go after the seller for. And most of the times people don't have an extra 10, 15, $20,000 lying around, right? So if that cost does get passed on to the buyer now, going forward, so imagine I want to buy a house for $1 million, $200,000 for down payment, $3,000 for lawyer fees. Commission is negotiable, but the land transfer tax is not negotiable, which I call the third commission. About say $15,000 to $30,000 goes to land transfer tax. Now you're going to need another $20,000 to $25,000 just to have a buyer representation, right? And I thought that was a great benefit for a buyer because you don't have to pay that.
Yeah, no, for sure.
Right, and you're able to get into that market. So if that does come into play, banks are going to have to start looking at your savings account to see if you can close and also pay the buyer agent, or they might come up with some creative strategy to incorporate that fee into the mortgage, or whoever's looking at $1 million is going to have to unfortunately look at $950 or $900. So things might change. So that's my understanding of it. And again, fees are always negotiable, and usually for us on the listing side, we have a package. We have a package for say 1%, 1.5%, 2%, and so on and so forth. And on the buying side, again, you don't pay anything, and we only get paid if you actually find a house, right? And we usually have a BRA signed before, where I think in the US it wasn't like that. So you would just go and show houses, and if they like it, that's when you get to work on it. So you're not really in an agency environment, like say if you were to get a retainer from a lawyer. So I think in Ontario, from what I know, we're a little bit ahead. But again, for the people who think that helps them, at the end of the day, the seller and the listing agent might win, because I think more buyers will just go direct to maybe save on the fee. But the real people who are going to get hurt are the people who can't get into the market, or the sellers who end up selling and then now have to pay a buyer to buy their next house.
Yeah. Okay. No, that's very well put together, man. All right. So I think this is like a question I get quite a bit from clients, and it's essentially, for first-time home buyers or even move-up buyers, whatever it may be. Do you recommend, or who do you recommend for pre-construction versus buying a resale property? And we can maybe touch on today's market specifically.
So great question as well. I think it comes down to like putting the price and the fancy gimmicks aside. It's like the timeline, right? So number one, can you buy a house today with the required down payment, and are you able to close? And are you okay with the payments, right? Or does that type of property exist in a resale market today? Sometimes it might not, right? So it comes down to yes or no. My go-to always is, if you're able to close today, buy a resale. And I'll be upfront, most of the times agents will get paid more to just do a pre-construction. But numbers-wise, it never makes sense, right? Price, almost 10 out of 10 times, is going to be cheaper on the resale side. I think maybe when our parents bought, it was the opposite way, which is why people made so much money. But it's much cheaper to buy a resale, and you could actually see it. You can go in and you can negotiate some certain things, right? But if say you only have a 10% down, and you don't want to go through the programs that we spoke about, and you need another year or two to come up with the remaining down payment, or that's when you're expecting your family to grow, or you're expecting to make a location change, then a pre-construction could make sense, because it gives you that time to come up with the down payment. But then, as we know, in the past year, things can change with rates, right? So I've done resale myself, and I've done pre-construction myself. It's case by case, but my go-to is always resale. If you don't have the down payment, or if it's just some money that you want to put away, say for an investment as a condo, and you're in no rush whatsoever to close on it anytime soon, and you're okay waiting 4 years, you can go the condo route. And one question I always get asked is, so simply, clients will say, I'm just going to flip the paper. I'm just going to sign it. And that's like the biggest red flag. It's like, you can never, ever, that's not an investment strategy, right? My first go-to is, are you able to come up with the 20%? Do you qualify for the mortgage? Are you going to move in? Are you going to rent it out, and what the difference would be, or would you be cash flowing? Never ask to, how much would it go, how much would this project go up so I can chop it after? That's never a strategy, and never a go-to. And I think for so many years, people have done that successfully, and with the way the market has turned down, where people have bought for more than what it was actually worth, and with the market going down, people are having a lot of struggles. But that opens opportunities for buyers to scoop up those properties at a fraction of the cost.
Which we're probably seeing a lot today, right? Yeah, I think you're right. Like hoping is not a strategy, right? You really need to kind of know your numbers and see if it really fits your strategy, like your investing style, right? So I just want to go in a little bit more because I know you said you've dabbled in both, right? So when you're looking at a pre-construction project, what sort of like factors and things are you looking at to either advise your clients or invest yourself?
So right away, my mind goes to price, right? So if it's a condo, I'll be like, this is what's going in the resale market. You're spending probably $100K more in pre-construction. Obviously, it's going to close in 4 or 5 years. Freehold-wise, I think right now there's some good opportunities, especially in Durham, where townhouses are still at 900 to $1 million. I wouldn't really say to buy that as an investment right now because there's such an influx of listings for sale and for lease. But if you're going to buy it for yourself and you only have $100,000, it's a no-brainer investment, right? So price for sure. If you're okay with paying a little bit more, and again, I'm not being agenty because I've done it before and I have paid 100, 150 more because the type of product that I wanted to buy, it wasn't available in the resale market, and I wasn't able to find something like that and close on it right away. I was okay waiting the 2 years. So letting the client know about the difference in price, obviously explaining that if the appraisal is short, these are some options, right? So it's not just the 20%, you shake the hand with the bank and you get financing. If there's a difference, what's your backup strategy to cover that difference? Are you going to be living in it or renting it, right? So for most part, you don't need to be a genius to know this. Putting 20% down, you're not going to cash flow with it being one unit, right? And it hasn't been for the longest time.
Yes, that's correct.
So there's that. Or if you're going to be moving in for yourself, then when do you expect to move in? When do you expect to get married? What's the income going to be? Are you able to carry that property? And then we obviously dig into who the builder is, looking at some stuff in the contract as to what the cost and development charges and stuff are, and location. Right, and what amenities are involved, and what incentives you're going to be getting, and are you okay with that? Right, don't just buy it out in say for example Waterloo just because the project is hot. Right, do you see yourself living there? No. Okay, renting wise, let's look at the numbers. And again, what is the backup strategy if you can't close, and what is the exit strategy, and how long do you see yourself holding this project for?
Like all the factors you mentioned, like I don't even think most people look at even like 10% of that, right? But one other big factor that I also just wanted to add on was I think a lot of people, especially during the last 2 years, they were expecting them to close and have the rate of 2% or 1.5%, right? Yes. So there's a big shock when they're starting to close at 5-6%, right?
And this has never happened in our lifetime,
exactly,
at least,
right? Exactly. So it's fair for them not to think that. But I think going forward, I think a lot of people, when looking into pre-construction, they're going to look at their worst case scenario, right? Run your numbers at 5.5, right? And see, can you afford those payments if that's the case when you close, right? And then, appraisal is a big issue. We're seeing that on our end, right? There are a lot of projects that, they're going $100,000, $200,000, $300,000 under their purchase price. And, they're stuck in a big bind, right? And, there are solutions, but they're not the best solutions, right? And
sometimes there's support for that too, right? Like some builders do have preferred lenders that even if there is an appraisal gap, they're able to do a blanket and still get you appraised for that value, so you don't have to come up with it. So there's that.
And then also there's vendor takebacks that they allow as well, some builders. So I think builders are being, creative on their end to kind of help people close as well. So if you're in that situation, definitely, reach out to your builder to see what options are available. And then, hopefully, there's something that they can offer to you that helps you close as well. As a realtor, because I know you work with a lot of millennials, what sort of advice do you have for the next generation that is looking to get into the market in the next year or 2 years ahead?
I mean, what I have done, I got into a bit of a conversation with someone recently who was saying it was not the same for millennials today and for me when I bought, but it's obviously saving up and maintaining your credit. I think people end up using their credit cards or getting cars and not really at least focusing on paying off the debts. And then leveraging your space, right? Like I didn't have much money in my family, but I think, for the most part, people would have some money either in their existing homes or their parents or siblings and stuff like that they're able to leverage. So those three things I think is great. Looking at the numbers every single day to see what's happening in the marketplace. There's never going to be a magical time, right?
100%.
Even if the market drops 20%, there's still people who are much more qualified, much more money in the bank, much more leverage than you, that they're able to take advantage of that scenario than you. And the natural human thing is, let's see if it goes down another 20%.
Yeah.
And we have seen that in the past, right? Market has come down, and how many people who said that still hopped in, right? And I think one question I have is, a lot of millennials are, self-employed, and they're doing amazing, right, in their craft. And one question I had from my massage therapist is, I'm self-employed, I'm reporting this much, how do I even get a mortgage, right? So I slightly hinted at, B lender could be an option because they're looking at, stated income, right? Could you maybe tell me a little bit more about that, or what you would advise to that young person?
No, it's funny you mentioned that, because we're working with a lot more entrepreneurs now than, let's say 2-3 years ago. And I think it's exactly that. I think a lot of people are shifting away from the salaried income jobs, and they're starting to do their own thing, right? Which is great to see. And there are a lot of and lenders are also seeing that too. So there's a lot of programs, even with the A lenders, where when you're putting less than 20% down, CMHC has some programs, Sagen has some programs where it's not a stated income program, but they are willing to look at a higher income if you're self-employed rather than your reported income, right? It is a case by case and industry by industry. Obviously, some industries are more favorable for that. So if you're in the massage, if you're a massage therapist in that industry, they will look at it in a certain way versus, maybe someone as a mechanic, for example, right? So there are some options even with less than 20% down. The best advice I can give for someone self-employed is have a great accountant and have a great mortgage broker, and have those two connect with each other. Because what we do also with a lot of our clients is we try to connect with them on an annual basis if they're self-employed to see if it makes sense to do a little bit of a higher reporting this year to get that switched over to a bank, right? Like, let's say we're just off by 10K, 20K. Let's just report that income and get you over to a bank. And then right when that gets done, we can get all of that refinanced, right? So I think just going back to it, like in general, number one thing is talk to a finance specialist, right? A mortgage specialist, right? Preferably a mortgage broker, so you can look at multiple options rather than just one. But just get that conversation started, right? Even if you're looking to buy 2 years from now, at least get the footing in place to figure out, okay, I'm off by 40,000 down payment or 50,000. How can we figure it out? And we can give you solutions, right? And then you can put that work in, and then maybe in 3-4 months you can figure it out and get ready to get in the market. Or if it takes a year, maybe, right? But at the end of the day, like, you won't know what's required until you start that conversation, right? So I think it's vital to start it at any point, as long as your intention is to buy real estate, right? And it's not for everyone, right? Like, if, for example, we have clients that plan to move to the U.S. because that's where their employer is headquartered, right? It doesn't really make much sense for them to buy here, right? For a primary residence, maybe as a rental, sure, but as a primary residence, no. So, you have to look at your lifestyle, whether real estate fits it. And if it does, which most people we work with does, then, speak to a mortgage professional and start that process as early as possible.
I think with all the tips that we said, I think we can both agree. I mean, like, we're like pretty old now in our low 30s, but when we first bought our properties in our 20s, it's just starting somewhere. And that first property doesn't really need to be your dream home. Or like, one strategy that me and my wife did is we bought a property, say 2 years before we got married, rented that out for a year, and then we settled in, right? So that way, when we're about to get married, prices are totally different. We're not focusing on buying real estate when we have other things on our plate, and we already have a place to move into once we're married, right? So just starting with something, and then the magic of climbing the property ladder is amazing because we've seen it for ourselves, but we also see it for our clients, right? And it's amazing when they touch. I mean, especially recently when they touch base, say even 2-3 years later. The difference of them jumping from a condo to say a detached without taking any money out of their pocket. It's just
Yeah.
it's truly magical.
Exactly,
right?
exactly. And I think that's like the opportunity we're seeing in today's market, right? Where people who bought condos, 3-4 years ago are now having such a large equity in their condo. Some are, holding the condo, refinancing and buying, but most of them are selling it
Right.
because they don't want to keep that property and deal with tenants. And that's, everyone has different preferences. And they're buying that detached home that they can
dream
grow
home.
their family
Yeah.
exactly in, right? And the best part is, like, they probably will make one other move after that
Maybe.
into
Yeah.
a bigger home, right?
Yeah.
Like, and at the end of the day, everyone has their own journey, right? Some will go from condo to detached, maybe condo, townhouse, semi. So the focus is, like, just see what you can qualify for, what your lifestyle is. We all have different lifestyles and what fits it, right? Maybe some folks want to, move as far as possible and live on a huge acreage of land, right? And some people want to be in the city, right? And if you're buying a detached in the city, it's very expensive, right? So maybe you get a bigger condo, right? So, so I think you just have to have a plan in play, right? And put that into action. I think that's the biggest thing. I think because you took action with your wife when you did, you were able to, use that equity that had grown to kind of move into the property you guys live in now, right? And I think that's where a lot of people don't realize it does take time, right? It doesn't happen overnight. Yeah, right. The appreciation we see in 2021, 2022, or 2020, 2021, they're not sustainable. But if you look at years prior, there was a slow and steady growth, right? And if you stick to that, you will also, be able to achieve those accomplishments as well. Yeah. So I know 2023 was a year where, there's a lot of doubt in the market. Headlines was, shooting doom and gloom into everyone. Interest rates are super high, close to even 7% in some cases. Are you able to share a success story? Because, we always hear about people, especially, in our industry, where people were pushing, hey, the quote, marry the house, but date the rate, right? But, there is some success out of that. So are you able to share, like, a success story from someone buying in 2023 and, what the results are as of today?
Yes, I can. So, these particular clients, they needed a spot for themselves. So they understood that the rates it is what it is, right? So they bought a condo with me, I think, in the summer at Kennedy and 401. It was a one bedroom. We got that for $536. And then he I guess he had some money and he was looking for his next opportunity. So he came to me, he's like, I want to look in the same area, but I want to find something for under 500. I looked at, what's available. I looked at what has sold, and for years there's nothing under 500. I'm like, this is not even possible, right? And how are you even asking me that when the smallest unit available, you got it for 536, right? But the moral of the story is you can't find deals if you don't, number one, talk about it, and you don't have people looking for it, right? So fortunately, this worked out where another agent that I have a good relationship with, he had an assignment sale. So it wasn't allowed to be advertised on MLS. And this was a bigger unit, 1+1. And again, so when you look for opportunities, especially right now, I think a lot of sellers, they are motivated because, they either want to offload it, they can't close it, or they bought something else, and so on and so forth, that we were able to find that bigger unit at 1+1, and we got it for 470.
Oh, wow.
And just yesterday, a similar comp sold for 515. So he's about $45K in just equity built in. And since the condo, it hasn't closed yet because it's an interim occupancy. So when we were wrapping up this deal, he was getting about 7%. Wow. And now rates have come down. He's getting quoted about 5%. So he has found, he's gotten appreciation. Rate has gone down by 2%. And it's an amazing unit, right? So if you don't need to even be serious. Like, I thought it was really impossible, right? But fortunately we were able to lock that up. And I think there are a lot of opportunities like that. Even with some of my sellers, they were just motivated because there is X, Y, and Z on the other side that, hey, if I'm going to take a $10,000-$20,000 haircut, I'm okay with that, because if I don't sell, the stress I'm going to deal with having two properties outweighs that $20K, right? So I think those are some opportunities that are available, and unfortunately, this couple was able to, scoop 2 condos in a matter
Yeah,
of
that's pretty awesome.
6 months or so.
Yeah.
Both great deals, right? And,
No, that's
in
awesome.
2 good buildings. So what about on your side?
Yeah, no, it's actually a pretty similar story in the sense where, so I had a couple as well. They weren't married yet, but they were getting married in a year. But they wanted to start their search just because they weren't sure if they would find what they would like when they were ready. And they also, similar to you and your wife, they didn't want to have a whole bunch of things happening at once closer to the wedding. So they were looking to tackle a little earlier. So they were particularly looking for a property where they can get a separate unit basement so they can house hack, right? So within their budget, honestly, they were probably looking in the East End Durham region. It was either an end unit townhouse or a semi-detached. Detached was a little bit out of their budget. So they were putting in offers, right? And I'll be honest, they were lowballing a lot of offers just because that was the market, right? Like there was no offers on properties and they were able to do that. And eventually they actually found a property that they put a lower than list price. They put, I think it was $30K under asking, right? They got it. And that property now, so they bought it in October of 2023. That property had a 6-month close. So by the time, similar to your clients, because the sellers were going through a marital issue, so they had a 6-month close. We first got it, it was locked in about 6.3 for the rate. And as of today, they're closing in at about I think in a few weeks, their rate as of now is 5.09. Nice. So a huge decrease in the rate. They got and then the best part is the price on that. A similar property on that street actually sold for $70K more just recently for very similar layout, and similar finishes. So they're up $70K. Their rates are down significantly, right? And they're able to house hack like they wanted. So while they wait till they get married, they're gonna rent both the top and bottom and cash flow. Surprisingly, in this situation. So yeah, like I think that's in my eyes, that's a success story because it met all their check boxes for them, and I think it shows because they took action, right?
You have to take action, right? I think people thought people were crazy buying during COVID, and so many people benefited, and 6%, 7%, super high. Like it makes me scared, but whoever took action during that time, I think with both these stories, it kind of shows, right?
Exactly.
You have to take action and prepare for the worst case, right? So say if rates stayed the same, even if rates stayed the same for them, I think they would have at least broken even. Exactly. But now, the appreciation's there, house is there, and the rate went down.
Exactly. And I think at the end of the day, you work with the right people, you have a plan in place. It's very, very unlikely you're going to lose, right? Obviously, there are factors that no one can control, like the Bank of Canada increased by 4.75 over 2 years, right? Like no one had that in their crystal ball, but at the end of the day, like if you made the right move, you didn't overbuy, and you can afford the mortgage payments, you'll get through it, right? And as things go down, they do come back up, right? It may be a slower ride up, but they will eventually get there. So I think there are opportunities in any market. It's just a matter of taking action.
Exactly. Okay, so great conversation. I think we dug into a lot.
Yeah, for sure.
And we'll wrap it up with that. So I'll leave both of our contacts below. And I hope whoever's watching this or listening to this learned at least 1 or 2 things, and that will mean that we did a good job.
Yeah, definitely.
Bye for now.
Take care, guys.